Mickey Dickey here, and want to give you an update on what's going on today because we got jobless claims out. And what does that mean for the market, and how is the market taking this news?
Yes, let's look at productivity, shall we? Non-farm productivity, this is second quarter final, moved up 1/10 to 3.5%. Unit labor costs also moved up 0.3 from expectations, 2.2%. Now, those were against expectations. How do they look in the rear view?
And I do think this is part of the jobless claims. It's not looked at as much as it should, and it's the productivity. Some of the economists that I listen to and follow will talk to that productivity being a much larger issue than even the jobless claims or unemployment or any of these other numbers. So I want to push this issue to the forefront of what's going on today. I think the productivity is a big thing. So when he talks about the fact that all the sections of productivity are up, keep that in mind. I don't think the market's looking at it. I think the market's looking way past it, but I think it's a much bigger issue, positive issue going forward than anybody's talking about, which today they're taking it as a negative. Clearly, as you can see, the NASDAQ's down, everything's down.
Well, 3.5 follows a 3.7 with respect to productivity. So that is definitely 2/10 lower than what we were considering for our second quarter final. And unit labor costs are benchmarked against 1.6. So these definitely merit some looking into. Now let's get into jobless claims. 216,000. This is really quite incredible. We continue to see down.
Now, he's going to say this here in a second. The estimate was 230. It came in at 216, and that's with unemployment going up last week. That's with jobs at 187 versus 177 as expected. And more importantly, they're continuing to revise these in a positive way too. Now, I know the old thing that we got going on here that bad news is good news is bad news and all that. I keep telling you folks, it's not a bad thing to have good employment. I don't care how the market's taking it today or tomorrow. It is never a bad thing. This is solid. It's not too hot. It's not too cold. It's everything we're looking for. It's a very solid report.
Downward pressure in claims. 216,000 happens to be the lightest level. Let's go into the Wayback Machine. You have to go all the way back to the last week in January to find a lower number than 216,000. I can find an equal number, 216,000, the second week in February. That's how far back we need to go. And on continuing claims, 1,679,000. We lost the 1.7 million handle. And there was some subtle revisions last month, downgraded a bit from 1.725 to 1.719. When was the last time we were under 1.7? 179,000 exactly equals the second week in July. You have to go all the way back to the January. Once again, we're going back to January.
So again, productivity is up. Unemployment is holding steady. Everything is running perfect. It's slowing down to doing exactly what we want it to do. The question is, are we panicking? And I shouldn't say we, the market. Is it panicking over what they think might be happening with the Fed and what they're going to have to do? Again, you read these numbers, you look at these numbers, the Fed does not need to do anything more. They just need to sit and hold and let the market do its job. It's all that needs to be done here.
You're on continuing claims. Now, we're all considering how much interest rates moved up. Well, they're moving up even more. We're hovering just shy now of 430 in a 10, 430 in a 10, and two-year note yields pop from 5% pre-number to 5.02. So we've seen a slight downgrade in productivity, a light upgrade in unit labor costs, and weaker jobless claims. And if you're looking at interest rates, folks, Andrew especially, I'll keep this really simple. Just look at the dollar index at a 3-month high, which means the euro's at a 3-month low. If you look at the dollar versus the onshore yuan, it's at the best level since 07, 16 years. If you look at the pound versus the pound's at a 15-month low. The dollar yen, the yen is almost really near a 10-month low. All of this is a quick glimpse into the psyche of the global dynamic, which is continuing to peg interest rates in the U.S. on the firm side. Andrew, it's all yours.
Our economy is continuing to grow. The stock market, as I keep saying, is going to continue to follow the bond. market. So if the bond market goes down, it's going to go up. If the bonds go up, like he's talking about, the market's going to go down. There might be a day or two inversion in there where that doesn't necessarily follow based upon some issues. I know we've got Apple coming out today with some more problems in China. Apple's a big part of the S&P. It's a big part of the NASDAQ. It's going to have some negative trends. But again, none of this is horrible. Now, again, the market may sell this off on a short-term basis, and don't ever invest based upon what's happening today or tomorrow or what could possibly happen today or tomorrow. You invest for the long term. Now, if you're a trader, whole nother issue. And please do not look at this in the same way. Traders do not invest. They trade, and there's a difference. You should be investing your money. You should have an advisor who's helping you invest your money, not trading your money. Again, traders, go do your own thing. And again, I'm not beating up traders, but it's a different world than investing. When you're looking at investing, you're looking at all this data that this is coming out here and where we're going to go in the long term. None of this is negative. None of this should make the Fed raise interest rates. None of this should make the Fed do anything different than what it was already planning to do. In fact, unless something comes out here when we get CPI that's really negative, I don't see why they would change anything at this point. So I had a couple other videos I wanted to show you.
Chief Economic Advisor at Allianz, also president at Queen's College at Cambridge University. Mohammed, let's just start with this premise of whether or not they're going to raise rates. We just heard from Susan Collins, or some commentary that Susan Collins has planned, and it sounded like she thinks she could be potentially in the point where the Fed does need to raise rates again. When you look at it, what's your take just based on the economic data we've heard?
So I think based on the economic data and based on the fact that the Fed is highly data dependent, they will not raise rates this month. That's what the market expects. There's over a 90% probability that the Fed keeps.
Okay. Which is really interesting to me, based upon how the market has performed over the last week, that we're still at 90% that the Fed's not going to go up. If you hear all the news and you hear all these guys on television talking about the fact that the concern supposedly is that the interest rates are going to go up, if they're going to go up, why wouldn't they go up this month when the Fed meets? I'm confused on that aspect. I don't quite understand why there seems to be this disconnect. I think it doesn't need to be done. He's already front-loaded this. He said from the start it was transitory. He wanted to let it go. No one would let him let it go. He wanted the market to deal with it. Now he's dealing with it. He wanted to front-end load it so that we get it handled. No one wants that either. It's amazing. No one wants to actually listen to what the guy's saying he's going to do and what needs to be done. Until Powell comes out and actually says he's got to raise the terminal rate, there's no reason for it. He agrees with it. Most everybody agrees with it. What's going on right now with the stock market? Again, it's a 1 week. It's a couple of days. To me, it's not even based upon anything of any reality. The reality is everything is going according to plan. The only mix-up here that I can see is that Apple is having some problems in China, and it's a big part of the S&P and the NASDAQ, and people are selling it off, which is an easy statement, but it's also selling off other things, which have nothing to do with Apple. So you got to question, why are they doing it at all? 9 out of 10, it's just because you've got a bunch of money managers who are managing large sums of money who are taking profit off the table and have to rebalance by the end of the quarter, which is the end of September. So some of them might be doing it now. Take it now when you can. Who's to know? If they're going to sell NVIDIA, you might as well do it now when it's high. So again, that's my opinion on this. Take it for what it's worth, but I do think we're in for some rough patches here. I think there's going to be some data that's going to be very confusing, because that's really what's going on here. You've got a bunch of data that's positive. It's all going the right direction, and yet everybody's concerned about, do we need to do more? Do we need to do more? No, we don't need to do anything. But it's all of the suspect, or whether we're going to do anything more, whether Powell is going to do anything more, whether we have to. It's all this speculation on what might possibly could be happen down the road. To me, sit back, relax, invest for the long term. There's nothing coming up here that's going to be negative. Even if what we're talking about here turns into a recession, and I've got some other videos I'm going to be coming out with that I'm going to give you my opinion on the recession angle on this going forward and how I think it's going to play out. But just what we've seen today, the market's responding to this mainly due to what's going on with Apple and a little bit of the people taking profit off the table. I think it's a short-term issue. And I think you're going to see the breadth of the market respond to this. I think you're going to see the fourth quarter. I think you're going to see the breadth catch up. I think you're going to see a lot of the smaller stocks that aren't in those top 7 really push the market forward. Not huge. I think it's just going to get back to where it was the middle of July. I think it's going to get back there by the end of the year. Make sure your portfolio is aligned where it needs to be. Talk to your financial advisor. Go for your long-term investment plans. Don't go for short-term. Again, don't let short-term blips mess up with your long-term plans. Dickie out.